I used to believe in fairness. That might sound naive, especially now, but back then, I really thought the system worked. I believed that if someone paid into something long enough, health insurance, life insurance, auto, property, then when things went wrong, the system would be there. That was the deal, wasn't it? You pay to be protected. You pay for peace of mind. But that's not how it works. Not really. What you don't see, the part no one tells you, is that insurance is a business of denial. It thrives on doubt, delay, and technicalities. It's not about helping people. It's about making sure we pay as little as possible, even if that means nothing at all. And that's what I did for a living. For 6 years. I was the one on the other end of the line when someone called after losing everything. I was the one who listened to them cry, beg, curse, plead, and still said, unfortunately, this claim does not meet the conditions outlined in your policy. Or worse, we need additional documentation to proceed. Knowing damn well that half the time, the documentation didn't exist, or we'd lose it on purpose. I got good at saying no with a warm tone. Good at guiding people in circles. Good at pretending I cared. That's what you're trained to do. Smile through the phone. Empathize, but never promise. Delay, deflect, escalate, until the person either gives up or dies. I can't tell you how many death claims I've denied. The reasons always sounded official: lapse in premium, missing medical disclosures, unclear beneficiary designation. But behind the screen, we had targets, metrics. A certain percentage had to be marked as unpayable. They don't tell you that in the job description. They wait until you're too far in. I remember the first time I flagged a claim for potential misrepresentation. The man had died in a fire. A father of 3. The house had been a total loss, and the policy was solid on paper. It should have paid out. But he'd failed to disclose a heart condition on a supplemental questionnaire. It had nothing to do with the fire, but it was just enough. Just enough to raise a flag, trigger a review, and freeze the payout. That review took 9 months. In the end, the claim was denied. The family got nothing. And I got a bonus. I tell myself I didn't make the rules, I just followed them. But after a while, that excuse doesn't hold. You start to feel it in your stomach, that gnawing sense that you're part of something wrong. You start waking up in the middle of the night, remembering voices. That woman who screamed at you because her husband's cancer treatment was denied. The man who sent you photos of his totaled car, begging you to help him because he couldn't get to work otherwise. And you told them the same thing: we're very sorry, but your claim doesn't qualify under your current policy. It's not a lie, exactly. That's the worst part. It's all technically true. But the truth is so twisted, so buried under legal jargon and loopholes, that it might as well be a lie. We had a phrase we used in meetings, quietly, behind closed doors: bleed them with paperwork. That was the game. Make it look like we were trying. Make it look fair. But the more hoops we created, the fewer payouts we made. We didn't call them people, we called them cases. We didn't say denied, we said decisioned. It was all about language. Language that softened the blow. Language that detached us from the damage we were doing. I'm not proud of it. But I wasn't the worst, either. I knew adjusters who joked about it, called it the sport. They'd compare who could reject a claim in the fewest number of steps. They kept screenshots of angry emails like trophies. One guy even had a mug that said, delay, deny, defend. We laughed. I laughed too. Because if you didn't laugh, you had to feel it. And feeling it was worse. People think the danger is in the disaster. The car crash, the house fire, the hospital stay. But the real danger is what comes after. When you think help is coming. When you think, at least I'm covered. That's when the rug gets pulled. That's when the system shows its real face. I remember this one woman. Her name was Elaine. 62 years old. Her husband died of a stroke, and she was just trying to access the life insurance they'd paid into for decades. She called every week for 2 months. Always polite. Always hopeful. And then one day, she stopped calling. I found out through a coworker that she'd passed away. Heart failure. Alone. The claim was still pending. That was the moment something in me started to crack. But I didn't quit. Not yet. Not then. I told myself I needed the job. I told myself I was just a cog in a machine, and if it wasn't me, it'd be someone else. That's how it works. That's how the machine survives. And most people will never see it, never know. Because we keep them distracted. We send glossy brochures. We are commercials about peace of mind. We let people believe they're safe. They're not. And if you think your policy will protect you when the time comes, you might want to keep listening. I didn't grow up dreaming of working in insurance. No little girl draws pictures of herself behind a cubicle with a headset, scanning PDF attachments for missing signatures. But life doesn't always lead you where you thought it would. Sometimes it doesn't lead you anywhere at all. It just pulls you along. And before you realize it, you're 10 years deep in a job you never wanted, doing things you never thought you'd do. After college, I bounced around. I had a degree in communications, which sounds impressive until you try to use it. I applied to everything: marketing assistant, receptionist, PR intern. Nothing stuck. Most jobs wanted 2 years of experience for entry-level pay, and rent didn't wait for resumes. The insurance job came through a friend. Her cousin worked for one of the big carriers, household name, shiny skyscraper downtown, benefits that actually kicked in on day one. She said it was just admin stuff, reviewing documents and calling clients to confirm information. It paid more than anything else I'd been offered. Full-time. Dental. I took it without blinking. They trained us for 2 weeks in a sleek conference room with free bagels and HR reps who smiled too much. We watched onboarding videos full of soft lighting and inspirational music. Happy families. Friendly agents. Words like security, trust, they're when it matters most. They told us we were making a difference. That we were the bridge between crisis and recovery. That we were part of something bigger. And for a while, I believed them. I really did. I learned how to process auto claims first, mostly small stuff. Fender benders, stolen property, weather damage. The training focused on policy language, response times, how to de-escalate angry callers. But what stood out most was the repetition. Always verify coverage. Always confirm exclusions. Always document the call. Everything had to be logged in our system. Every pause, every question, every breath someone took. We weren't just helping people, we were creating a paper trail to defend ourselves if they sued. They didn't say that part out loud, but it was always underneath everything. Still, I told myself it was just procedure. That structure made things fair. That we were following the rules. And rules are good, right? But then came the cases that didn't quite fit. The ones where the damage wasn't clear, or the driver was technically listed as a non-covered operator, or where a claim was filed 10 hours past the reporting window. We were taught to flag those immediately, to review for inconsistencies. That meant passing them to the special unit. The one nobody really talked about. Later, I'd learn what that meant. But at the time, I thought it was just due diligence. A second pair of eyes. I thought, if someone deserves to be paid, they'll be paid. That's how it works. It's not. The special unit wasn't there to help. They were trained in denial, trained in what we called claims mitigation. Basically, how to not pay claims without getting sued. And once a case went there, it almost never came back approved. But we didn't see the outcome. Not at first. That's how they kept us compliant. They isolated us from the damage. My transition to life insurance claims was where everything shifted. It's not as fast-paced as auto or property. It's quiet. Morbid, even. You don't get screaming calls about broken windshields, you get soft voices. Widows. Parents. Grown children whose voices crack on the phone. The claims came with death certificates and obituaries attached. And I had to match those files with policies, confirm the insured, check for lapses in premium. Every now and then I'd find something that felt off. A $500,000 payout requested by a nephew who didn't seem to exist. Or a policy that had expired 2 days before someone died. But for the most part, they were clean. Normal. Honest. And yet, we denied them anyway. I remember sitting in a weekly meeting where my manager walked us through our conversion funnel. That's what they called it, a funnel. Like we were selling ads. At the top were incoming claims, and at the bottom were payout resolutions. The narrower that funnel got, the better our department performed. Not for the claimant, for us. That's when it started to click. We weren't here to help. We were here to resist. The internal systems we used were deliberately clunky. Our file viewer was ancient, documents loaded in grayscale, like old faxes. The software timed out every 15 minutes, so you had to save constantly. But none of it was accidental. The inefficiency was the point. The more friction there was in our process, the fewer claims got processed on time. The more claimants gave up, missed deadlines, made mistakes we could use later. It wasn't about denying everything, that would draw too much attention. It was about slow suffocation. About bureaucracy doing the dirty work for you. Sometimes I'd go home and try to forget it. I'd tell myself I was helping weed out fraud. That it was my job to protect the system so it could help the people who really needed it. But every week, that story got harder to believe. I still remember the first time someone said it out loud. One of the older adjusters, someone who'd been around for 20 years. He looked at me during a break, sipped his coffee, and said, "Don't make the mistake of thinking we're in the business of paying people. We're in the business of not paying them." I laughed. Thought he was just being cynical. He didn't laugh back. That was the first crack. And once you see the first one, you start to notice the others. How the policies are written in language most people can't understand. How agents are incentivized to sell the most expensive plans, not the most appropriate ones. How entire families can be bankrupted by a single error on a form they signed 10 years ago. The illusion was beginning to fade. But I didn't walk away. Not yet. Because part of me still wanted to believe. Part of me still thought that maybe, just maybe, I was wrong. But I wasn't. By my second year, I knew the words before people even said them. But I thought I was covered. I've been paying into this policy for over a decade. No one told me I had to. They always said it like that, half confusion, half desperation. And each time, I'd walk them back through the same script. Calm voice. Slightly tilted head if we were on video. Never interrupt. Always sound like you're helping. It didn't matter if they were right. What mattered was whether we could find something that made them technically wrong. That's the thing about insurance policies, people think they're contracts. But they're not. Not in the way you think. They're more like mazes. Carefully worded, deliberately structured, with clauses hidden like traps. If you haven't spent weeks parsing the definitions of accidental injury versus intentional act, or material misrepresentation, or loss of use exclusions, then you're already at a disadvantage. You sign something without ever understanding it. And we knew that. We were trained to use that. In one of our quarterly workshops, they brought in a consultant from another regional office. A guy who'd helped slash payout costs by nearly 18% in under a year. He gave a PowerPoint called "Turning Gray Areas into Red Flags." I'll never forget that phrase. He explained how gray area cases, ones that weren't clearly valid or clearly fraudulent, were the sweet spot. You didn't deny them outright. You slowed them down. Requested documentation that would be nearly impossible to obtain. A police report from another state. A notarized affidavit from a witness no longer alive. Proof of mailing from a form sent 5 years ago. You make them work for it. And if they give up? Well, that's not your fault, is it? We also used soft scripting, something corporate pushed heavily. It wasn't just about what you said, it was how you said it. We were given whole sheets of approved language, designed to guide the claimant into compliance without ever saying no. Let's go ahead and take a look at what's needed next. In order to proceed, we'll just need a bit more from your end. Unfortunately, at this time, I can't confirm coverage. Notice the language? It's never definitive. Never aggressive. It creates the illusion of movement. Of cooperation. When really, the file's already been marked internally. Do not advance. There were even psychological tips included in our training. Keep your voice steady, but warm. Mirror the caller's speech rhythm, makes them feel understood. Ask them to help you understand their situation, even though it changes nothing. Give them a sense of control, right before you deny them that control entirely. We weren't just adjusters. We were handlers. And the more practiced you became, the more seamless it all felt. I could sit on a call with a woman whose home had burned down, whose pets had died in the fire, and still maintain the same calm tone, the same professional rhythm, even while reviewing a clause that would cut her payout in half because the fire was caused by negligent use of heating equipment. A space heater plugged into an old socket. That was all it took. I remember one manager actually saying during a performance review, "Your empathy to denial ratio is excellent." Yes, that's a real phrase. Empathy to denial. The idea was to make them feel heard, just enough to keep them from suing. Because lawsuits are the only real threat. We didn't fear complaints. We didn't fear bad reviews. We feared litigation. But the reality is, most people can't afford to sue us. Not when they're already in crisis. Not when they're broke, grieving, or trying to rebuild their life from rubble. That's when they're the most pliable. You want to know the worst part? The system counts on that timing. The claim process is front-loaded with emotion. People are scared, vulnerable, mentally exhausted. They don't have the energy to fight. They're more likely to accept a partial denial. More likely to believe it's their fault for missing some fine print. We had a department that tracked dwell time, the number of days between a claim submission and the claimant's first follow-up. If someone didn't follow up in a week, they were tagged as low pushback risk. We'd deprioritize the case, knowing there was a good chance they'd never escalate. And that, in a way, was the game. Quiet resistance. Gentle obstruction. Not so harsh that it raised red flags, but just enough to tip the odds. Because the numbers told us everything. Our performance metrics didn't just track how fast we processed claims. They tracked how few we advanced without a challenge. We were expected to question, to investigate, to cross-check, even when there was no reason to suspect fraud. That's something the public never understands. Fraud is vanishingly rare. Less than 2% of claims. But internally, we treated every single claimant like they were trying to pull a fast one. And if they got angry, that worked in our favor. An escalated call could be flagged as aggressive behavior and transferred to a compliance handler. That reset the claims clock. More delay. More attrition. More chances for them to give up. We had the advantage at every level because we weren't operating in reality. We were operating in procedure. And procedure can't feel. It doesn't cry. It doesn't plead with you. It doesn't show you the children left behind by a denied life policy. It just checks the box and moves on. By my third year, I stopped telling people where I worked. Not because I was ashamed, at least not then, but because I couldn't stand the reactions. People either joked about it, "So you're the one who screws people, huh?" Or they launched into stories about how their mom's surgery wasn't covered, or their uncle's claim got denied after he died on the job. They wanted answers I didn't have. Or rather, answers I wasn't allowed to give. And even if I could, what would I say? "I'm sorry. The system is working exactly as designed." I was becoming numb to it. Not because I didn't care, but because caring made it impossible to keep going. Still, I kept going. Because you learn how to compartmentalize. You learn how to separate what you do from who you are. But the cracks were getting harder to ignore. And eventually, they'd split wide open. There's a strange thing that happens when you've been doing this job long enough. You start to recognize patterns. Not just in the claims themselves, but in the people. Their language, their tone, the way their desperation rises and falls depending on what stage of grief they're in. The ones who are angry right away, the ones who stay polite even when you're clearly stonewalling them, the ones who go silent for a long time and then come back with a lawyer. But there was one case, one woman, that didn't fit into any of the categories. Her name was Lydia. I remember it because she spoke so clearly, like every word had been rehearsed, not robotic, not insincere, but like she knew exactly what she was doing. Calm. Focused. The way you sound when you've cried so hard, there's nothing left but precision. She was filing a claim on her husband's life policy. 47 years old. Massive heart attack while jogging. She was his listed beneficiary. The policy was in good standing, paid on time, fully active, issued 12 years earlier. And it wasn't small. $750,000. At first glance, it looked clean. Straightforward. But the moment I submitted the claim packet for processing, it came back flagged. I didn't even know we had that kind of automation set up, an internal trigger that lit up the moment certain conditions were met. I'd seen special review notes before, usually for things like suspected fraud or high-risk activity. But this flag was different. It didn't say, fraud suspected. It said, refer to underwriting integrity audit. That wasn't a standard department. In fact, I'd never even seen those words strung together. I asked a colleague about it, and she just gave me that tight little nod, the one that meant don't ask questions you don't want answers to. So I didn't. Not right away. Instead, I watched what happened. Lydia's claim stopped moving. Not denied. Not escalated. Just paused. We weren't allowed to say it was under investigation. We were told to say, under review for internal accuracy. It meant nothing. It meant everything. I had to call her weekly with updates. I hated those calls. She never lost her temper. Never raised her voice. But I could hear it, the quiet erosion. The way her voice got thinner. The way she started double-checking my words. Asking me to repeat phrases. So, you're saying the policy is active. And there's no dispute about cause of death. So why exactly is it delayed? I didn't have a real answer. I asked my supervisor, just casually, what the integrity audit meant. She avoided eye contact and said something about verifying original application materials. Then she added, almost as an afterthought, some policies were fast-tracked during that quarter. You know how it is. Fast-tracked. That was another red flag I hadn't known to look for. See, when you apply for life insurance, you're usually required to undergo medical underwriting, a full evaluation. Labs, interviews, sometimes even a physical exam. But every now and then, to boost sales, the company would do promotional pushes. Express approval. Instant coverage. No exam required. Just a health questionnaire. It sounds convenient, especially to the customer. But what we knew behind the scenes is that those fast-track policies, they were never meant to mature. They were like lottery tickets the company printed, assuming most people wouldn't die during the payout window. If they did? Well, that's when the audit came in. A retroactive inspection. They'd go back through the original application, compare it against medical records, looking for any discrepancy. A missed allergy, a forgotten ER visit, a prescription not disclosed. It didn't have to be related to the death. It just had to be there. And that was enough to trigger a material misrepresentation denial. In Lydia's case, her husband had once been prescribed beta blockers, years before the policy started. He never mentioned them on the form. Not because he was hiding anything, but because he'd stopped taking them, and they were for mild anxiety. Nothing cardiac. Nothing serious. But that was the out they needed. I saw the denial order come through 6 weeks later. Claim denied. Non-disclosure of material medical history. Just like that. They didn't accuse him of lying. They didn't need to. They simply said the policy would have been rated differently had the prescription been disclosed, and therefore the coverage was void. Void. That word always stuck with me. Not denied. Void. As if it had never existed at all. I had to make the call. Lydia didn't say anything at first. The line was quiet. Then she asked me to repeat it. Not the whole message, just the final word. Void, she said. You're telling me the policy is void? I confirmed it, even though I hated myself for it. Then she asked me something that made my stomach turn. Was it always going to be void? I didn't know what to say. I wanted to tell her yes. That the minute her husband clicked submit on that application, the company already had an escape hatch built in. But I didn't. I said the line they told us to use. We can't speculate on underwriting decisions beyond what's documented. She hung up without saying goodbye. That was the moment I started wondering how many of these policies were built like that. How many people were walking around thinking they were protected when in reality, their coverage was little more than a technicality, ready to be unraveled the moment it was needed. And the more I looked, the more I saw them. Policies issued during bonus seasons. Plans pushed during sales contests. High-value policies sold without medical exams. We called them soft-shell plans. Inside the company, we all knew what that meant. On paper, they looked solid. But they cracked under pressure. That realization didn't break me. Not yet. but it left something behind. A question I couldn't unask. A whisper that wouldn't shut up. How many people were out there, living with a false promise? And worse, how many died believing someone they loved would be taken care of? The thing about death, when it comes through the phone line, is that it never sounds the way you think it will. You expect sobbing, panic, screams, maybe, but it's almost never that. Most of the time, it's quiet. Hollow. Like the voice on the other end is still catching up to what happened. Like their words haven't quite landed in their own body yet. He passed yesterday morning. We found her when we got home. It was sudden. They said heart failure. And just like that, it begins. They think they're calling to inform us of something tragic. But we already know. The obituaries, the death certificates, those come in fast. We have alerts built into the system now. In some states, we're notified of death records before the family even contacts us. And internally, we move quickly. We don't move quickly to help. We move quickly to assess. A new death claim means a risk event. A potential loss on our end. So the moment that file is created, a process kicks in behind the scenes, one most policyholders never see. It starts with a data sweep. We run a full profile through our back end. Not just medical records. We pull up credit activity, employment history, pharmacy data, even public social media posts. Yes, really. A grieving husband might not know how to navigate the claim forms yet, but we've already built a risk profile on him. We know how likely he is to contest a denial. We know if he's ever filed a lawsuit. We know if he has a criminal record, a history of missed payments, or signs of instability. All of that matters, because it tells us how hard we can push. One of the more senior analysts once told me, grief is the best compliance tool we have. I didn't understand what she meant until later. Until I started noticing the patterns. There's a small window right after someone dies, usually 7 to 10 days, when people are too overwhelmed to fight back. That's when we send the first packet. It's deliberately dense. 36 pages. Legal language. Conditional requirements. A checklist with ambiguous deadlines. We don't send it to help them. We send it to slow them down. Because the longer it takes them to respond, the more leverage we have. If a form is late, we can reclassify the claim as inactive. If documentation is missing, we can flag it for further review, even if it's something minor, like a middle initial not matching exactly on a medical record. And if they call to complain, we loop them into what's called the bereavement queue. That sounds compassionate, doesn't it? But it's not a support line. It's a containment line. Staffed with reps trained to express empathy without advancing the claim. They're taught phrases like, "I can only imagine how difficult this must be. We'll make sure this gets the attention it deserves." The process can be confusing, but I'm here to help. They're not there to help. They're there to absorb the emotion, to deflect, to stall. All while the real decisions are made somewhere else, deep in the back end, where analysts pore over policies with highlighters and keywords, hunting for anything that can be used to void the contract. You'd be amazed at what counts as grounds for investigation. A missed doctor's visit. A prescription never picked up. A single yes on a question that should have been no 12 years ago. Even benign things like applying for a new credit card can be flagged as material changes to financial status and used to argue that the policy was entered into under false pretenses. We had a case once where a man died of a stroke and his wife's claim was denied because he had once omitted a chiropractor visit on his health disclosure. A chiropractor. For a sore back. We claimed he knowingly withheld relevant medical history. Policy voided. For $100,000 gone. And we were congratulated for catching it. An internal email even used the phrase, "excellent risk containment." That's what they call it. Not a family devastated. Not a widow bankrupted. Risk containment. We don't see their faces. That's the point. We don't see the funeral photos, or the empty bedrooms, or the unreturned wedding rings. We see PDFs, polished reports. Digital folders marked green, yellow, red. Every human life reduced to a color-coded threat level. And sometimes, the policy itself is perfectly clean. No omissions. No misstatements. Nothing to deny. But even then, we have options. Did you know that in most states, we don't have to pay interest on a life insurance payout unless you specifically request it? Most people never ask. Most don't even know they're entitled to it. So we delay. Not a full denial, just small pauses. A week here, 10 days there. Time required for internal processing. Time that benefits us financially. We earn interest on the funds while the family waits for a check. If the payout is large enough, we sometimes try to steer the beneficiary into a retained asset account. That's when the money doesn't go directly to them, it sits in a pseudo bank account we control with limited access. We market it as a convenient benefit, a way to give them time to decide what to do with the funds. But behind the curtain, we're just earning off the float. While they mourn, we profit. I used to feel queasy about it. Still do sometimes. But most days, you don't let yourself think about the specifics. You work the cases. You follow the script. You manage the dead. That's what the job becomes after a while. Not helping, not healing, managing. And if you're lucky or unlucky, you get good at it. You learn to read silence. You learn to time your pauses just right, to say, I understand, even when you don't, to tell someone their spouse's death is under review, like you're reading a lunch order. It wears you down. Not in one blow, but in thin, quiet layers. Death stops feeling like an ending. It becomes just another folder. Another account. Another form waiting to be processed or postponed. But you never forget the voices. Not the angry ones. Not the quiet ones. And not the ones who never call back at all. We used to call them squeakers. The ones who didn't hang up. The ones who knew the policy backward, who quoted the exclusions to us before we even opened the file. The ones who wrote letters to corporate, to the state insurance board, to anyone who would listen. You'd think those were the people we feared. But that's not quite true. The ones we really feared were the quiet fighters. The ones who didn't scream or rant, but just kept showing up. Calm. Prepared. Persistent. Because those were the people who sued. And when they did, everything changed. There's a whole protocol that kicks in the moment legal paperwork crosses our inbox. The claim is reclassified. Locked from public access within the system. The audit trail is frozen. And the file is pulled from the regular adjusters and handed to what we called the containment team. They're not part of the claims department. They don't talk to clients. They're former lawyers, risk analysts, damage control experts. Their job isn't to win a legal case, it's to make it disappear before it ever reaches court. You have to understand, lawsuits are dangerous not because we'll lose. We rarely do. We're insured against that, ironically. No, the real danger is exposure. Every court case opens the door to discovery. That means depositions, email records, underwriting documents, training materials. And hidden in those documents are the patterns, the informal quotas, the denial algorithms, the unspoken instructions that can't be publicly defended. We didn't deny that woman's claim because of a medical omission. We denied it because her husband's policy was issued during a sales bonus period, and we were instructed to verify high-risk payouts. But you'll never find that in writing. So we make it go away. I remember my first exposure to the process. It was a claim I'd handled, minor case, denied over what I thought was a genuine error in the paperwork. The claimant, a woman in her 50s, had lost her younger brother. The policy was small, maybe $100,000. But she wasn't backing down. She'd already written 2 certified letters to our compliance office, filed a complaint with the Department of Insurance, and was now working with a local attorney. One of the internal council members flagged it as low risk but optics sensitive. That meant she didn't have much legal ground, but the case looked bad. It could catch attention. So we made her an offer. That's how most of these end, not with a judgment, but a settlement. A carefully worded, confidential payout that includes a non-disclosure clause and a full release of liability. Most people take the offer. They're tired. They want closure. We know that. That's why the first offer is always low enough to tempt them, but not enough to admit fault. But some people, rare people, they refuse. When that happens, we escalate. The company has something called a reputational exposure index. It's not publicly documented. I only saw it because I worked next to a guy in special risk for 3 months while our teams were being reshuffled. The index ranks each case based on two factors: likelihood of media coverage and potential for precedent-setting discovery. If you score too high on either one, your case goes into containment by resolution. That's not a legal term. That's an internal directive. It means we settle, we pay more than usual, and we do it fast, but with silence built in. Legal teams swoop in with tight NDAs, airtight clauses, and a pile of conditions so thick they almost look threatening. Most recipients don't even realize how close they came to cracking something open. But I've seen the math. I've seen what we'll pay to avoid public records. A man once sued us after we denied his wife's death claim, accidental overdose, which we marked as self-inflicted, even though her toxicology report showed clear evidence of a pharmacy error. He wouldn't take our offer. He went public. Posted her story online. Got traction. Within 48 hours, we settled for 5 times the policy value. That was the first time I realized. We're not afraid of paying. We're afraid of people finding out why we don't. And here's something most people don't know. We keep lists. Not just of policyholders, but of attorneys. There's an internal tag system. If a lawyer has ever filed against US before and won, they're marked. The tag includes their style: litigious, aggressive, precedent-seeking, media-prone. When one of those names shows up on a file, the entire tone of the claim changes. We'll pay faster. We'll offer more. We'll bypass protocol to avoid going up against someone who knows where the bodies are buried. And believe me, some of them do. I spoke once, just once, with a lawyer who represented a family we denied. I wasn't supposed to speak with him directly, but he'd caught me on a call transfer and asked a question I wasn't ready for. Not legal. Not accusatory. He just said, "Do you know how many people think they're covered, but aren't?" I didn't answer. Because I didn't know. More than anyone wants to admit. More than the company will ever acknowledge. The silence we buy through settlements, it's not about avoiding court. It's about protecting the illusion. The illusion that the system is fair. That the rules are clear. That your coverage is what you think it is. But it's not. And if you ever try to prove it, if you ever get too close to the truth, we'll handle you. Quietly. Legally. Efficiently. There's a kind of tragedy most people don't recognize when it happens. It doesn't involve a scream or a bang or some spectacular betrayal. It's quieter than that. More methodical. Like a faucet dripping in the dark, one drop at a time, until the whole floor is soaked and you don't even remember when it started. That's what happens with valid claims. Yes, some policies are outright denied. Some are voided, flagged, tossed into legal containment the moment they start moving. But others, the ones that are actually legitimate, those are handled differently. We don't deny them. We drown them. The most effective way to avoid paying a large claim isn't to fight it. It's to stall it until the claimant gives up, runs out of time, or dies before it gets resolved. That sounds dramatic, I know. But I've seen it happen. We called it process attrition. A cold phrase for a cruel system. It starts simple. You delay the acknowledgement. Technically, we have a legal window, varies by state, usually 15 to 30 days, to respond to a claim submission. But that's just a response, not a resolution. So we wait the full duration. No contact. Let them stew. Then we respond, asking for documentation we know they already submitted. Not always the full packet, just one item. A medical release form. A beneficiary ID copy. A certified death certificate, even though the digital version is already attached. We don't reject their submission, we simply pause it for missing information. This resets the clock. That's the trick most people don't realize. Every request for additional documentation pauses the processing timeline. Not officially. Not on paper. But internally, the moment we say, we can't proceed without this, the file is marked as pending claimant action. It's no longer on us. It's on them. And if they miss a deadline, even by a day, especially if it's something like a notarized form or an out-of-state certificate, we send a letter marking the claim as inactive. Now here's where it gets worse. Reactivating an inactive claim isn't automatic. The claimant has to request it in writing. If they don't know that, the file just sits. We're not obligated to follow up. Not unless they do. So the delay grows. Weeks. Months. Eventually, most people assume it was denied and move on. Or they get lost in grief and forget. Or they simply don't have the strength to chase us anymore. I once had a case that sat inactive for 18 months. The payout would have been $350,000. The beneficiary was the insured's elderly mother, 78 years old, living alone, no attorney, no internet access. She missed a form deadline by 5 days. When her son died, she called us twice a week. I remember her voice soft, apologetic, always worried she was doing something wrong. After the 3rd month, she stopped calling. We never followed up. When I finally checked the file a year and a half later, she'd passed away. No secondary beneficiary was listed. The money went unclaimed. That happens more than you think. We call them dead-end payouts. Funds that don't get released due to technicalities, expired claims, or lack of documentation. They don't go back to the families. They don't vanish either. They sit in holding accounts earning interest. Technically, they're still liabilities on the books. But they're delayed liabilities. And the longer we delay, the more we profit. Here's another fact no one talks about. Insurance companies are built on delay. The entire business model depends on collecting premiums now and paying out later, much later, if at all. Every extra day we keep a payout from leaving the building is a day we can use that capital elsewhere. It's why some of our internal targets weren't just about denials, they were about duration. If a claim reached resolution too quickly, it was flagged for review. Unusually expedited processing, they called it. Not in a good way. Managers would pull us aside and ask, "Did you explore all necessary verifications?" Translation: you paid that too fast. We were never told to stall directly, not in so many words. But the system was built to reward inefficiency. Caseloads were too high, staffing always just slightly under-resourced. Delays were framed as inevitabilities, not design. But we knew. We knew that when we asked someone to get a form notarized, it might take them a week to find a bank that offered the service. That when we requested an official copy of a marriage certificate from another state, it might take 3 weeks and cost them $45. That asking someone to call a doctor's office for a copy of a record from 2009 was setting them up to fail. But that's what we did. Over and over. And you can't say you weren't warned, because it's all in the documentation. Tiny fine print. Neutral phrases. Language like, failure to submit all required documentation within 30 days may result in the closure of your claim. May. Not will. Not automatically. Just may. That's how they cover themselves. It's always your fault. Your delay. Your misunderstanding. We just follow procedure. I told myself that for years. That I was following the rules. That the system was what it was and my job was to work within it. Not to question it. But after a while, the pattern becomes impossible to ignore. Not just the denials. Not just the settlements. But the silence. The slow suffocation of perfectly valid, perfectly honest people who just give up. And the worst part is? That's exactly what we counted on. Some cases stay with you, not because they were loud or tragic or complicated, but because they were too clean. That's what made this one different. There was nothing to dispute. Nothing to delay. No form left unsigned. No history left undisclosed. Everything was correct. Every box checked. Every date aligned. It should have been simple. But it wasn't. His name was Alex. 39 years old. He died in a construction accident, struck by falling scaffolding while working a late shift. The company confirmed the incident. OSHA was involved. There was surveillance footage. The death certificate was submitted within a week. So was the policy information. His wife, Rima, was the beneficiary. She'd included everything. Driver's license. Marriage certificate. Employer verification. Even notarized statements from 2 coworkers who witnessed the accident. Her submission was flawless. Like she had studied how to beat the system. That should have been the end of it. We should have paid. But someone higher up flagged it. Not because of any issue with the claim, but because of how good it was. The official term was suspicious completeness, a red flag for overprepared claimants. We were told to be cautious of anyone who knew the process too well, because it might suggest prior legal help, insider knowledge, or premeditated fraud. Let that sink in. Being too organized was now a reason to investigate. Rima's claim was pulled from my queue within days. I was told to reroute it to a forensic adjustment review, which sounded official, but was really just another stalling department. I'd seen them in action before. They'd pore over claims that were already complete, looking for ways to reinterpret the policy language. In this case, they focused on one clause. Coverage excludes incidents arising from willful negligence, including, but not limited to, breaches of documented site safety protocol. They used that line to dig. Apparently, the job site had a rule against working above a certain height without a secondary tether. Alex had his primary harness on, but the secondary clip wasn't attached. That was enough. They argued that the lack of a second clip constituted a violation of safety protocol, and therefore the death wasn't accidental under policy terms, it was a result of willful negligence. Let me be clear, this wasn't a suicide. It wasn't reckless behavior. It was a man doing his job. And dying on the job. But because one piece of equipment wasn't clipped properly, they spun the whole thing into a technical exclusion. I was stunned. This wasn't a soft-shell policy. It wasn't fast-tracked or voidable. It was rock solid, issued through a union benefits package, employer-matched. 12 years old. No gaps. No misstatements. And still, they found a way out. I pushed back. Quietly. I flagged it for review. I submitted a case note citing potential public optics concern. I even sent a discreet message to my manager asking if we were really prepared to fight this if it went to court. Her response was brief. Her lawyer missed the contestability window. Proceed as instructed. That's when I learned something new. In life insurance, there's a clause most people have no idea exists, the contestability period. It's usually 2 years from the policy's start date. During that window, insurers can void a claim for any material misrepresentation, even something minor. But once that window passes, claims are supposed to be protected, unless there's evidence of fraud or clear exclusion criteria. In Alex's case, the 2-year window had long expired. But exclusions? Those apply forever. And they're subject to interpretation. So that's what they used. Not fraud. Not error. Just interpretation. It worked. The claim was denied. Rima appealed. Denied again. I watched it unfold like a slow-motion collapse. She started out sharp, writing detailed letters, referencing union protections, quoting policy lines. By month 3, her tone had changed. The letters got shorter. Her calls stopped. The last note on her file just said, "Claimant unwilling to pursue further escalation." File closed. She gave up. And for the first time, I felt something snap inside me. Not rage. Not grief. Just a hollow thud of understanding. We hadn't beaten her with power. We'd beaten her with process. Everything she did was right, and still, we wore her down. And now we got to walk away clean. No lawsuit. No bad press. Just another line item, quietly resolved in our favor. After that, I stopped believing in mistakes. There were no mistakes. Just systems doing what they were built to do. If a valid claim could be spun into a denial, it would be. If a grieving widow could be discouraged into silence, she would be. The scariest part wasn't what we were doing. It was how normal it felt. No alarms. No outrage. Just another Tuesday. Another family broken by fine print. Another file marked closed. That was the moment I knew there was no going back. No redemption arc. The illusion was gone. And the next time someone asked me, "Do you think I'll get the payout?" I finally stopped pretending I didn't know the answer. I used to think the worst thing we did was deny people what they were owed. But that's not it. It's deeper than that. Quieter. And much harder to explain. The worst thing we did was teach people not to expect help in the first place. Because once you stop expecting anything from the system, you stop fighting it. You stop resisting. And that's where the real profit is, in the silence. In the surrender. That's what took me years to fully understand. Years of watching cases come and go, watching voices grow small, watching grief turn into resignation. I used to believe the system failed people. Now I know the truth. The system is designed to manage the fallout from your suffering, not to stop it. We didn't just deny claims. We priced human loss. We turned it into a metric. Into probability charts, risk pools, actuarial projections. Death wasn't an emergency, it was a line item. Tragedy, when mapped and measured correctly, was profitable. And here's the part most people will never believe unless they've seen it from the inside. Insurance companies make more money when people suffer slowly. Not catastrophically. Not suddenly. But over time. Let me explain. A sudden death, like an accident, is expensive. Payouts are immediate. The policy hasn't had enough time to generate return. It's a loss. But a long illness? A drawn-out decline? That's different. People dip into policies early. They borrow against them. They forget to pay premiums. They downgrade their coverage to make ends meet. And then, when the time comes to collect, there's some clause, some lapse, some technicality that cuts the payout down or eliminates it entirely. The longer the suffering, the greater the odds will win. I saw it with terminal cancer patients. We had entire training modules built around accelerated benefit riders, the clauses that let you access life insurance funds before death to pay for treatment. Sounds compassionate, right? But we were trained to look for ways to deny those advances, to require second opinions, to question the diagnosis timeline, to demand documentation that doctors were often too overwhelmed to provide. Meanwhile, the patient suffers. Bills pile up. The stress increases. And sometimes, this is the part one still can't fully process, they die before the benefit is approved. And if no payout was issued, we saved the full amount. I once handled a file where the claimant died 3 days after their accelerated benefit approval came through. But the check hadn't been issued yet. Because of that, the company reversed the entire process. Denied the living benefit, reduced the final payout based on the adjusted policy value, and saved nearly $80,000. No one talked about it. No one questioned it. It was just policy. We also tracked churn behavior, when policyholders hit financial hardship and stopped paying premiums. It happened a lot in the last few years. Layoffs, rising costs, medical debt. People let their policies lapse. Sometimes they didn't even realize it until it was too late. The moment coverage ends, the file is tagged inactive. But if that person dies within a certain window, say, 60 to 90 days after their last premium was missed, we investigate. Not to help their family. No. We investigate to make sure the policy can't be reinstated posthumously. We check timestamps, call logs, IP addresses, anything to confirm the lapse was valid. If it is, we walk away clean. No payout. No liability. Just another technical win. And again, the family never saw it coming. Because most people don't read their policy documents. And even if they do, they don't understand them. Why would they? The language is designed to blur, not clarify. Take this clause, buried deep in most policies. No benefit shall be paid for loss caused directly or indirectly by self-inflicted injury, whether sane or insane. Sounds straightforward, right? But the word indirectly does a lot of heavy lifting. I've seen that clause used to deny claims for everything from drug overdoses to complications from untreated mental illness. One case involved a man who stopped taking his insulin due to depression. He died after slipping into a coma. The claim was denied under that clause, self-inflicted injury. Technically? Maybe. Ethically? God, no. But we didn't operate on ethics. We operated on viability, how defendable the denial would be if challenged. And if it looked airtight on paper, we pushed it through. Sometimes I wonder how many of us, inside the building, were carrying the weight. I mean really carrying it. Not in the performative way. Not in the I just follow the rules way. But in that deep, quiet guilt that crawls in at night. The kind that doesn't make a sound, but still keeps you awake. We all had our lines. Some of us drew them earlier. Some never did. I remember this one guy, Paul. Worked across the hall from me for years. brilliant adjuster, efficient, a walking policy manual. But one day, he left his badge on his desk, walked out at lunch, and never came back. No notice, no call, just gone. 6 months later, I saw his name pop up on a whistleblower report. He'd written a full letter to the State Insurance Commission, outlining internal practices, quoting emails, even naming managers. But nothing happened. No investigation. No hearing. No press. Because he'd signed an NDA when he left. And the company reminded him, very firmly, what that meant. I never saw him again. And I never spoke his name in the office. That's what the system does to people. It teaches you to stay quiet. To keep your head down. To bury your conscience under procedure and forms and legal phrasing. Because if you don't, you become a risk. And risks are contained. Looking back, I don't think I stayed because I agreed with what we were doing. I think I stayed because I didn't know where else to go. Because the longer you're part of something like this, the more you start to believe it's the only way the world works. But it's not. And the moment I finally walked away, I realized how much I'd normalized the grotesque. I walked away on a Thursday. No plan. No announcement. I closed the last claim I could stomach, turned off my monitor, and left my badge on my desk just like Paul had. I didn't say goodbye. I didn't need to. When I stepped outside, I expected to feel relief. I didn't. Not at first. What I felt was nothing. Not sadness. Not freedom. Just this heavy, airless space where all my justifications used to live. I stood there in the parking lot, hands in my coat pockets, and I remember asking myself, how many people did I hurt by doing my job well? How many families did I gently, professionally walk away from their only chance at stability? How many voices did I help silence? And the worst part is, I'll never know. Because the system is designed that way. No closure. No aftermath. Just file closed. Case resolved. Risk contained. That's the part that still gets to me. We never had to see what happened to them. After the denial letters, after the appeals, after the polite voices on the phone finally broke into static, we never had to see what came next. The eviction notices. The cars repossessed. The GoFundMe links quietly posted by friends. The unpaid hospital bills handed to grieving spouses like receipts for lives that didn't make it. But someone should see it. Someone should say it out loud. So, that's what I'm doing now. Not because I'm brave. But because I waited too long to tell the truth, and I don't want to wait anymore. Because this system, the one we're told to trust, the one that promises protection when things go wrong, it doesn't exist to protect you. It exists to protect itself. And we're all taught to look the other way. Agents are taught to sell. Adjusters are taught to stall. Policyholders are taught to hope. Hope that the policy will be enough. Hope that someone on the other end will care. Hope that tragedy won't be followed by betrayal. But hope is not a strategy. So I want to ask you, if you're listening, if you've made it this far, I want to ask you something that no insurance company ever will. Do you know what your policy actually says? Not the summary. Not the sales pitch. I mean the fine print. The exclusions. The conditions. The loopholes you were never meant to find. Because I didn't know mine until I started reading them for other people. And by the time I understood how fragile that safety net really was, it was already too late for so many of them. And maybe it's not just insurance. Maybe this story is bigger than that. Maybe it's about all the systems we trust without questioning. All the signatures we give without understanding. All the ways we're conditioned to accept less, ask less, expect less, even when it's our lives, our families, our futures on the line. So I want to hear from you. Have you ever had a claim denied that you thought was guaranteed? Have you ever watched someone you love fight a system that was supposed to protect them? Have you ever looked at your coverage and thought, this isn't what I was promised? If any of that rings true for you, tell me. Tell all of us. Share your story in the comments. Say what they don't want you to say. Because I know I'm not the only one who saw behind the curtain. I know I'm not the only one carrying this guilt. And maybe, just maybe, if more of us start talking about it, the next person won't have to learn the hard way. You don't have to scream to be heard. Sometimes, all it takes is telling the truth and letting the silence fall where it should. Thank you for listening. Really, now it's your turn.